Good day, I am Raphael Odhiambo, a transfer pricing and international tax consultant at Deloitte Kenya, and I will be speaking through the changes proposed to the Significant Economic Presence Tax Regime, SEP, in Kenya's FY25-26 budget, and how these reforms align with the OECD's Pillar 1 and Pillar 2 frameworks. The Finance Bill 2025 proposes to expand the SEP tax to capture any income that is accrued in or derived from Kenya by a non-resident through a business carried out over the internet or an electronic network, including through a digital marketplace. The SEP tax was introduced through the Tax Laws Amendment Act 2024 with effect from December 27th. This replaced the digital tax, which had been enforced since 1st January 2021. The digital services tax regime applied to all the income accrued in or derived from Kenya by a non-resident from the provision of services over the internet or electronic networks. The laws as currently worded provide for the SEP tax regime to apply only on the income accrued in or derived from Kenya by a non-resident from the provision of services through a digital marketplace. The proposal to expand the scope of SEP tax is intended to broaden the tax base to include all digital service providers with a meaningful economic footprint in Kenya. Under Pillar 1, the OECD introduced a new nexus rule based on significant and sustained engagement with the market rather than physical presence for reallocating tax rights on non-routine profits of large multinational corporations. Kenya's significant tax proposals mirror this approach by focusing on economic presence and user-based metrics to determine taxable nexus in line with global consensus on digital taxation. Another key proposal is the removal of the 5 million Kenya shilling turnover threshold, meaning all non-resident digital service providers with significant economic activity in Kenya, regardless of size, will be subject to SEP tax. However, this could raise questions around administrative efficiency versus actual tax yield. These reforms enhance equity by ensuring non-resident digital businesses pay taxes in jurisdictions where they derive value. The reforms also introduce new compliance obligations requiring entities to review operational models, digital platforms, and data reporting systems to ensure seamless adherence. For deeper, more detailed insights, we invite you to our budget analysis event on 13th June 2025. See you then.